Hey everyone, welcome back to Corporate Decoder, the place where we decode the complex world of corporate finance with a smirk and a whole lot of digging. Today we are diving deep into Lithium Americas Corp's Q3 2025 report, and let me tell you, there is a lot to unpack. This report for the quarterly period ended the 30th of September 2025 gives us a snapshot of how Lithium Americas is doing, especially with their big Thacker Pass project ramping up. We will skip the boring company details and get straight to what matters most: the money, the risks, and what it all means for their future. If you love getting straight to the point on company financials, make sure you are subscribed and join our Discord community, linked below for even more insider discussions. Let's get right into the numbers. Looking at their balance sheet, we see total assets reaching a hefty $1.45 billion as of the 30th of September 2025. That is a big jump from $1.04 billion at the end of 2024. What is driving this growth? A massive increase in mineral properties, plant and equipment, which shot up from about $398 million to over $1 billion. This clearly shows they are pouring money into developing their Thacker Pass project. On the flip side, liabilities also surged to $555 million, up from around $99 million at the end of 2024. A significant chunk of this increase comes from convertible debt and a conversion feature, which jumped to nearly $387 million. This means they are taking on more debt and have financial instruments that could turn into shares later. Now let's talk about the income statement. The company is still deep in the red. For the 9 months ending the 30th of September 2025, they reported a net loss of $223.9 million. That is a huge increase from just $21.4 million in the same period in 2024. A big reason for this massive loss is something called loss on financial instruments measured at fair value. This hit them for $185.9 million in just 9 months. This is largely driven by changes in the value of their embedded derivative linked to convertible debt, a topic we will touch on more later. Looking at the equity statement, we see common stock increasing significantly. For the 9 months ending the 30th of September 2025, they raised over $66 million through their at the market program and another $57.5 million from a previous program. Plus, they brought in $100 million from GM's investment. This is how they are funding all this development. The cash flow statement paints a clear picture of a company investing heavily. They used almost $526 million in investing activities for the 9 months ending the 30th of September 2025, mainly for additions to mineral properties, plant and equipment. This dwarfs the $111 million used a year prior. Financing activities brought in a substantial $364 million in 2025 compared to $262 million in 2024, showing they are actively securing funds. So what is the main story here? Well, Lithium Americas is all in on Thacker Pass. They are spending big bucks to develop this lithium project in Nevada, and it is clear they are not generating operating revenue yet. They are relying heavily on debt and equity financing to keep the lights on and the bulldozers rolling. Let's dig into some of the more interesting financial details. The company has a joint venture with General Motors for Thacker Pass. As of the 30th of September 2025, GM's non-controlling interest in this venture stood at over $420 million. This JV is a variable interest entity, meaning Lithium Americas has to consolidate its financials. This is a really important point because it means a large chunk of assets and liabilities on their balance sheet belong to this joint venture. Remember that huge loss on financial instruments I mentioned? Well, a big part of that comes from the convertible debt and an embedded derivative associated with it. On the 1st of April 2025, they closed a $250 million investment from Orion Resource Partners. This included convertible notes and something called a production payment agreement. The embedded derivative alone is valued at nearly $284 million as of the 30th of September 2025. This part is tricky, but basically a feature in their debt means its value changes with their stock price. And when their stock price went up a lot, a large loss was recorded. This fair value measurement note really highlights the complexity. Their embedded derivative is valued using fancy math and assumptions about future stock price volatility. The loss recognized in the period was a staggering $193.8 million, just for the 3 months ending the 30th of September 2025. This is why the company's stock price movements are so critical to their reported losses, even if they aren't making or losing actual cash directly from operations. On the project front, things are moving. During the quarter, they capitalized another $145.9 million in construction costs. Engineering is over 80% complete and they are installing steel. They have about 700 workers on site now and expect that to grow. They even have a workforce hub, or what they call a WFH, complete with an occupancy permit. After the quarter ended, things accelerated. They completed their at the market equity program, selling millions of shares and raising hundreds of millions of dollars. They also amended their loan agreement with the US Department of Energy, the DOE. This brought the total loan amount down slightly, but also included some sweet deferrals on debt payments and warrants for equity stakes for the DOE. Then on the 20th of October 2025, they received their first massive drawdown of $435 million from that DOE loan. Also, Orion converted a significant portion of their notes into company shares. The company is now a US filer following a separation in 2023. They are heavily focused on Thacker Pass and are managing it through a joint venture with GM. They clearly state they are not generating revenue and expect to continue losing money until Thacker Pass starts producing, which is targeted for late 2027. The 9 months ending the 30th of September 2025 saw general and administrative expenses rise to $24.1 million and transaction costs more than doubled to $18.3 million. All this spending is for the project and increased reporting requirements. The loss on financial instruments measured at fair value is the big story here, soaring to $185.9 million from just $5.8 million in the prior year. Looking at the balance sheet again, cash decreased significantly to $385.6 million from $594.2 million at the start of the year. This is while mineral properties, plant and equipment nearly tripled to over $1 billion. Liabilities more than quintupled to $555.3 million, mainly due to the Orion debt. Lithium Americas believes they have enough liquidity for the next 12 months with cash and their DOE loan. However, they are heavily reliant on these financing arrangements and face restrictions. They have raised substantial funds through equity offerings and the GM investment, but still have significant debt obligations, including those from Orion and the DOE. The risks are substantial. They are worried about changes in US trade policy and tariffs, especially on materials like steel, which could increase construction costs. Most importantly, their ability to keep drawing on the DOE loan is contingent on meeting strict conditions. Failure here could be a major setback. They also warn that future sales of their stock could depress its price, potentially making it harder to raise capital later. So what is my take on Lithium Americas Corp? Well, they are in a high stakes game, investing massive amounts of capital into a single large project. Their relationship with GM and the DOE are critical lifelines, and they are managing these complex financial instruments with significant fluctuations in reported earnings due to fair value accounting. The growth in assets is impressive, showing progress on Thacker Pass, but the ballooning liabilities and the reliance on external financing are clear risks. The company has strong partners and a potentially lucrative project, but the path to profitability is long and fraught with financial and regulatory hurdles. Will they pull it off? The numbers show incredibly aggressive investment and significant risk. They are betting the farm on Thacker Pass, and their stock price movements directly impact their reported financial results due to those derivatives. It is a high growth, high risk situation. Alright, that is our deep dive into Lithium Americas Q3 2025 report. What is your take on these numbers, and what do they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.